All right. Hi, everybody. I'm Paul Grand, CEO here at MedTech Innovator. Welcome to another episode of our MedTech Innovator webinar series. This is a series that we run all throughout the summer as part of our MedTech Innovator Live series, which you can access either here on our YouTube channel or on medtechinnovator.org/live. Pretty easy to find. So our webinar series is powered entirely by the companies that are part of the MedTech Innovator Accelerator program, a total of 62 companies in our US program, 20 in our Asia Pacific program this year, for a grand total of 82 startups and scale-ups who are working with us to evolve their technologies and to do everything we can to help bring those technologies to patients faster and in a way that delivers as much value as possible. So that's what this is all about. We have a series of webinars on different topics, and the questions and the topics themselves are driven by our companies. So they tell us what they want to hear about. And today's discussion is going to be to talk about some of the trends that are happening in MedTech finance, MedTech M&A, and to really get kind of a lens on what's happening, because all of you and many of you who are out there, I shouldn't say all of you, but many of you who are out there are raising money or ultimately are going to probably partner with somebody and sell your company to someone. So this is a good time to kind of get a lens on what's happening in the landscape. I know a lot of people are curious about whether COVID has affected things. So we'll have that and other things to talk about today. We've got a terrific panel. The panel today is going to be moderated by David Cassak from MedTech Strategist. And he's going to be talking with John Norris from Silicon Valley Bank and Marc Chaput from Gravitas Healthcare. I'm going to let David do the introductions. So let me hand it over to you, David. And before you give your introduction, I just want to make sure I tell everybody that MedTech Strategist has been a longtime partner of MedTech Innovator, tremendous publication and event series. So if you haven't yet subscribed to MedTech Strategist, I highly recommend you do so. It's an incredible long-form journalism opportunity for MedTech that you just won't find really anywhere else. It's a place I really learn everything that's happening in the industry. So it's my cheat sheet for knowing what's going on. So I recommend you do that as well. And when their event series comes back in person, I definitely recommend you go to the events. Again, really highly informative and just great networking and probably the best turnout of investors in our space. So with that, let me introduce David Cassak, and David, you can introduce the other panelists.
Thank you, Paul. And you gave me a nice introduction, so I'm going to turn right to our panel. Before we get into the discussion, I wonder if John and Marc, you want to just give us a 30-second overview of Gravitas and Silicon Valley Bank, just to give our audience an orientation about where your views come from. So, John, why don't you go first, and then Marc.
Great, thanks, David, and thanks, Paul, for inviting me. And just to give you a sense of Silicon Valley Bank, we are a commercial bank that focuses on working with early-stage technology companies. So, if you have some sort of secret sauce behind your product, those are the companies that we like to work with. We work with companies from idea on the napkin, without venture funding, all the way up through venture funded and public companies. We have 30 plus offices in the US. We have a UK office. We have a Germany office now. We have 3 offices in China and also an Israeli office. So we really are kind of nationwide and international at this point. And my role is really to manage all the venture capital relationships for the bank. And also we put out a report twice a year that really looks at in-depth at all the information that's going on on the investment side as well as the exit side. So, in the end, if you're looking for a really interesting partner that can provide value over and above banking in terms of advice and perspective on the industry, then SVB is a great place.
Great, John. Thanks very much. Marc, you want to give us a quick overview of you and your organization?
Yeah, and appreciate the opportunity to be here. For about 10 years after graduate school, I worked at Deutsche Bank, Alex Brown, and Cowen doing medical device investment banking. After Cowen, with my business partner, Sam Navarro, we started Gravitas Healthcare, and we've been doing that for about the last 12 or 13 years. We just work with private emerging growth medical device companies. Just on the advisory side, we get hired to help create alternatives, which typically mean M&A, but it can also mean distribution deals or strategic investments, both of which can be the dating before the marriage. Our typical client is approaching an inflection point, typically a regulatory clearance or a pilot launch. We often get brought in a year or two, or sometimes even more ahead of that, to help folks navigate that partnering process.
Great. Paul, do you want to just remind everyone how to ask questions during the course of this interview, the course of the session, and the strategy for the last 30 minutes?
Sure. Thank you, David. So the way this works is that the companies that are part of the MedTech Innovator Program are part of the live webinar here. They're able to ask questions that we're going to be looking at the end of the program. So for like the last 15 minutes or so, we'll address some of their questions in this live discussion, depending on how long the content goes in the first part. And then, so it's a total of 1 hour for the live broadcast, 30 minutes for a private Q&A. So as soon as we're done with the first hour, we're going to go to a Q&A mode where it'll only be for the companies that are part of the program, and that won't be broadcast. But for any of you who have questions, please do one of two things. If your question is something that you want us to address in real time, so we're talking, if you hear a comment and you say, wow, I really want to hear more about that, I want to unpack that a little bit further, you can put that into the chat box. If it's something that you want us to answer at the end during the 30-minute Q&A session, please use the Q&A feature for that. So again, comments during the discussion go in chat, comments for questions for afterwards go into Q&A. And that's it.
Great, thanks, Paul. So John, you made reference to the very fine and informative report that SVB puts out every year. I know you've got some data points that you want to share with us. Just to kick it off, though, I noted going through the data that M&A seems to be severely off the first half of the year, a much more than 50% drop. And I wonder, do you attribute that mostly, exclusively, only in part to the pandemic? Are there other factors going on right now that you think are affecting the deal volume and deal valuations?
Yeah, I'll talk a little bit of that, and Marc, feel free to jump in too. But I feel like, one, if you do look sort of historically, there tends to be more M&A in the second half of the year than the first. So I will put that at least a little bit into context. But it feels that the acquirers really are in kind of two camps right now. The first camp is either folks that are continued to be very acquisitive and in talks. And I think when the pandemic did hit and the stay-at-home sort of action sort of started out, there was a pause in a lot of ongoing discussions. And some of those discussions have started back up again. But I think they've kind of reset a little bit on valuation. But you have the one camp that really is continue to be acquisitive, and then you have the other camp that maybe had a little bit of a stock hit, had to think about, okay, let's think more internally. Let's make sure that we understand what's happening within our own company, what's going on with revenues, what's the impact to surgical volumes, and how does that affect my overall health as a company before I start to think about outside innovation out there. So it does feel like more acquirers are in the second shop than the first. But that's kind of what we're seeing right now. So we remain hopeful that the second half will be a little bit more aggressive than the first half.
So Marc and John, feel free to follow up on that specific point. I'm surprised that you put anybody in the acquisitive camp right now. We as startups always identify ahead of time companies that we think are likely acquirers down the road. Is there anybody left in the acquisitive camp? If I'm a small company out there and I've identified some companies as potential acquirers down the road, are there any that I should be continuing to have discussions with now because they're in the acquisitive mode? Or has everyone basically shut down? And John, I don't know if you want to follow, or Marc, you want to jump in and see what you're hearing when you talk to strategics about their plans for this year.
Yeah, maybe I'll take here and then John jump in. But just adding to John's points from before, I think people are getting adjusted to this new normal. right now. So, definitely a lot of folks tapping the brakes on, processes that were underway as everyone's trying to figure out what this new normal is. I think adding to one point that John made earlier, I think the part of this new reality is individual companies firepower, so their ability to deploy capital really is kind of case by case where that has been impacted. Clearly, the large consolidators that had larger cash reserves or the ability to access capital markets a little faster than others or in multiple ways are probably better positioned to weather this out. So I think where you've seen a lot of the real tapping of the brakes is on some of the smaller more mid-cap acquirers that are just trying to get their arms around what their businesses, what their core businesses look like.
So while, Marc, just a follow-up on that, while the regular economy has been poor, particularly around unemployment figures, the stock market actually has rebounded nicely. Does that suggest that deals that are going to be done as stock deals? Are there any cash deals out there? Or companies, the early pronouncements and the early reporting from the big strategics in April were that their volumes were just way down and their revenues were way down. If you're willing to take some stock, are you more likely to get a deal done than if you're looking for a cash deal? Or is that not an option? Are the small companies not the ones to make that decision?
Yeah, I mean, the small companies are not the ones to make that decision, but they're the ones to say no if that's the offer. I do think there'll be more relative to before. There'll be more stock components of deals. Just again, as folks are being mindful of cash reserves going forward, but the reality is, most acquirers, most deals of smaller startups are going to be cash deals because you're typically the counterparty is typically a large consolidator that doesn't want to issue equity, especially for some of these smaller tuck-ins. So I would think most of them are going to be cash deals still.
And are you seeing any trend toward, the last decade has seen just a proliferation of billion-dollar deals. I noticed on the venture side, and John, you may have a perspective on this, the investing side, there seems to be a lot of big investments. I'm thinking Reflection raised $100 million. Several companies raised a lot of money in later stage deals. And conversely, over the last decade in the M&A side, there's been tons of billion-dollar deals, really large deals, even though historically, the typical deal was in the $150 to $250 million range. Do you think that we will see more of one kind of deal rather than another going forward? Is this a climate that favors small companies because they are less economically or financially burdensome, or is this a deal where is a climate where those deals get wiped out and really the only ones worth pursuing are the big deals that may have been in discussion for a while?
Yeah, I think in the immediate term, we're going to see more tuck-ins, which I think is what you've been seeing more in the last 2 or 3 years, anyways. After the wave of the bigger consolidators consolidating and then digesting those deals. As deals get done because folks are looking either for growth or for scale, and those needs are not going away. But I think that in the immediate term, again, just from playing it safe, you're going to see more tuck-in type deals, but then certainly the need for scale, is out there. And you referenced, some of these larger financings, as maybe some of the IPOs that might have been done this fall or early spring, or kind of put on pause. Those companies, are going to get bigger and are able to raise financing, raise capital from some of the crossover investors and whatnot. And these are big financings, and those companies are, again, assuming fundamentals in place, are just going to continue to get larger and become more attractive.
John, you have some really interesting data around segmentation, particularly around clinical spaces. And when we were talking the other day, you mentioned that cardiovascular has been surprisingly depressed this half year, this in 2020. Can you put that data up? Do you have, or can you speak to which clinical spaces or which subsegments of the device industry are most active these days, and which ones are less active than one might have thought?
Yeah, absolutely. Let me share my screen here in just a moment. But maybe just to piggyback on a couple of the points that Marc made, when I do talk to investors out there, and we start to think about, you know, what's the activity out there from the acquirers, it did feel like, especially sort of in April and into May, that if there was some acquisition interest out there, it was really a buyer's market with you know, what we saw as more low ball type offers, where there's some really interesting technology. Maybe these companies are really early into revenue, so obviously the revenue impact would be significant, and maybe these acquirers could pick things up on a discount. But I don't think those really went anywhere. But that was a little bit of the mentality of the acquirers that were more active, at least at that point in time. I do feel like, as I mentioned before, there's more of the bigger acquirers that are now really interacting and having real discussions. And when you think about sort of the Medtronics of the world that sort of, you know, took a break from venture-backed device acquisitions for a couple of years, to see them back in the market and doing some deals is really good to see. But
I would pause there to say that, you know, a dozen years ago when the recession hit, I would talk to guys in the business development side, and I would say, you know, these guys are really suffering and they're cash strapped, and you could pick up some really good deals at the time. And to a person, the biz dev guy said, no, we don't do those kinds of deals. We don't do cheap deals because, you know, a bad done deal cheaply is still a bad deal. So I would be surprised if there's a lot of bottom skimming on the M&A front here, because these guys don't really care about the cost, the price of a deal. They care about the long-term impact of the technology.
Right, but you know, if you do have an innovative technology and there's an opportunity to pick it up at a good price, I think it's worth exploring. But when you do look at, you know, the other side of the ball, which is the company itself on the private side as well as their investors, you know, I think the other thing is there's a lot of capital out there to continue to support these companies. And when you think about this as maybe a temporary issue, you know, obviously this is a very difficult, you know, situation we find ourselves in with the pandemic, and where cases are going and where things are going is sort of anybody's guess, but a lot of things are kind of not going in the right direction. But I think investors have capital to continue to deploy, and I think that's kind of a big part. And if you want, I'll go to a couple slides I think are pretty.
Yeah, please go to your slides now and show us.
Absolutely. Okay. Oh, actually, I think, Paul, I'm not allowed to share right now. If you could give me, or David, if you can give me permission.
I'm not the one that would give you permission. Paul would.
I'll take care of that. Stand by. Hold on one second, John.
No worries.
There you go. You should be able to do it now.
Ah, here we go. Let me see. Let me know if you can see that. Can you see that?
Yes.
Says healthcare venture capital fundraising?
Yeah.
Okay, cool. So I think, yeah, this slide is pretty interesting because this looks at venture funds that are investing mostly in the US, but it's all venture capital funds. And what I look at is, all right, when that fund is closed, how much of that is actually going to be invested into healthcare, specifically within biopharma? Oh,
sorry, John, to interrupt. I was going to say, can you just make it full screen?
Oh, I'm sorry. I thought I did that. Sorry about that.
Okay.
There we go. Yep. And then we look at how much of that venture fund is actually going to be allocated to healthcare, either biopharma, medical device, tools and diagnostics, or health tech. And you can see over the last 3 years, a substantial amount of fundraising each year from 17 to 19. But I think, you know, 2020 is really an amazing year because that orange bar represents only 6 months worth of 2020. And it's almost hit the record number for the full year of 2019. So a ton of capital has been fundraised out there. And when you think about it from the company perspective, that just means that a fund being closed means they're going to be deploying that new capital into new portfolio companies to them over the next 2 to 3 years. So,
and do you think that capital raise is a function of the fact that these companies like Gilda, which raised a huge fund in Europe, or LSP on the device side, those fundraising were already in progress, or do you think these are companies who see opportunities as a result of the pandemic and are stocking up to make deals? I would think particularly on the biopharma side, with the opportunities and things like vaccines and therapeutics, you might have companies that are really thinking, a couple of years out and saying there's real opportunity if we can get in now, or was this all baked into the numbers before the pandemic hit?
It's mostly baked in, but I will say the fact that they have closed maybe quicker than anticipated could be related to sort of opportunities related to COVID-19. But I will say especially in the public market, and that's almost across all sectors, we've seen just amazing performance in these IPOs, post-IPO run up afterwards. And what that does is that provides a lot of markups for these venture funds and distributions down the road. And that sort of enabled some of this fundraising. And if you look at the chart down below, you can see, there are a couple folks here that I've highlighted on some of the bigger funds that do invest in device, like, NEA and Deerfield. And General Cowles does a little bit, and even Andreessen Horowitz will do some, diagnostics as well as device. But it's just a lot of capital that's out in the market, and I think that's sort of the reason why we've seen such good investment. And just to give you a sense, and I won't spend too much time on this slide, but overall investment in the U.S. and Europe is way up. And if you look at this first half number of $19 billion versus the full year number of $33 billion, we're really on a track to have record investment in healthcare. And what's nice to see is that, while device is not necessarily seeing the uptick that biopharma and DX tools are, you're seeing a nice steady pace. And, what we've seen also, just to give you some context in that, is that I was pretty worried in Q2 when the pandemic hit and the stay at home, and we saw, revenues fall for a lot of these companies. Because when you think about it, device is probably the biggest predicate sector that really relies on getting companies into revenue. I would say, health tech is maybe second behind that. But when you start to see these early companies that have major revenue impact, does that quell investment? And what we saw was almost an even amount of invested capital in Q1 versus Q2. So it was really good to see that you continued to see investment in that arena. But $2.2 billion at the half year mark is not bad for device. And I think, overall, we've started seeing device as sort of the steady state among healthcare sectors. We continue to bump along with, good M&A and IPO activity, but not spectacular like you've seen in biopharma, but just very stable. And it's good to see that continue. And maybe
John, let me ask you one question. I noticed health tech is less than half of what it was in 2019. And there have been reports, there have been kind of anecdotal reports that I've been hearing that health tech, after kind of booming during much of the 2010s, has begun to cool a little bit. Are you seeing? And I've always thought that health tech, which has obviously a device implication, but that was beginning to draw some dollars away from MedTech investing. All these other relationships are, close to, or maybe even a little bit more than half. But health tech is down less than half of what it was, not by a whole lot, but by some. Do you sense any softening in the health tech side?
Actually, no, and there's a reason why, and it's it's sort of more in the footnote than the commentary, because when you do look at some of these companies, they do tend to overlap sometimes. Like some device companies, you could say, oh, it's a device company, but it also could be a health tech company, or especially in like the diagnostic analytics side, that kind of fits within DX tools, but also health tech. So the sort of key to this slide is that we don't want to double count any company. So if there is a company that could go into both categories, we actually chose one category only, and it was actually all to the detriment of health tech. So if it
Okay.
overlaps with health tech, we didn't count the health tech part.
Okay.
So it's a little bit, so when we actually, within this paper, we actually have a health tech section itself where we put those dollars back in, and it's actually fairly healthy. We saw the deal activity explode in health tech. So it's a little bit of a tougher one because we just had to place a company in a sector. So that's the reason why maybe we're seeing health tech a little bit smaller.
So not to put you on the spot, but do you know Cala Health, which has the tremor suppression?
Yeah, that's in device
technology. That would be what?
That would be in device for us.
That would be okay. Great. Okay. Do you have some data on M&A in MedTech?
Yeah. Do you want to see a little bit more on the financing side first, or should we
sure,
just
a little bit? Sure.
Great. And so, excuse me while I go through. So maybe just really quickly on the DX side, because I know there are some diagnostic companies that are sort of part of the audience that we see here. A couple of things here is that one, on the DX test side, we continue to see a decent amount of new Series A financings in this area, but the dollars have been down pretty significantly. But if we look at overall in the sector, DX tests actually kind of exploded, and that's really because you saw a couple of the really big companies like Grail and Lumira DX and Curious all raised really big rounds in the first half of this year. But you do see a lot of these test companies getting interesting investor interest, and part of it is COVID-19 related. When you look at the bottom right down here with the DX test, these are all the companies that have at least some part of their technology that's pursuing a COVID-19 related opportunity. So you are seeing actually a lot of activity, especially in the DX and tool side, where there's opportunity to leverage technology for helping out in the pandemic. And I think that's gotten, not only your usual investors in the DX side, but also maybe some, I hesitate to use the word tourists, but folks who are maybe not as familiar with the sector, getting excited about what this means, and the fact that, the idea around getting tested and getting results, I mean, it's really at the forefront of all the news that you're seeing out there right now. So
and do you think
really
this is
has been a part of that.
Do you think this is Darwinian? I mean, that half of these guys will wash out before too long, or
no,
how many of these guys have staying power?
Yeah, I think that, and that's really the important point, that these are not COVID-19 companies. These are folks that are leveraging their technologies to help with COVID-19. And if we end up seeing an issue with viruses continuing to come back up and we create multiple pandemics down the road, who knows what that situation is. The fact that these companies have the ability to do that is important, but it is important to also note that most of these companies have, if not all of them, have other business units that are non-COVID-19 focused. So it's leveraging their technology right now in a situation that's kind of dire with this pandemic, but it's also the underpinnings of the company is not COVID-19. So I don't think there's going to be a washout. There could be a situation related to valuation though, because I think that may be one issue where, some of these companies are getting maybe a little bit of a higher valuation because of the exuberance of what they're developing. That may in the end be a little bit harder, because we have seen over time, DX tests are a difficult sector, because getting a test on the market is one thing, getting commercial reimbursement and revenue ramp is another. And that has really been a sort of a struggle over time. And so maybe with that, just we'll quickly go over to the device side. And I won't spend a lot of time on this, but I will say, the one thing that we have seen is not only, while we see DX or we see device is actually, decent in terms of the amount of capital they raised, you can see that the dollar amount has sort of gone down each year and these are just looking at half year numbers, not the full year, just to try and create the context of what we're seeing in the pandemic. Good news is, deals have stayed fairly stable, but the bad news is the dollars have gone down significantly. But if you do see where are the most of the activity happening, it's really in non-invasive monitoring, which is kind of like vital monitoring, as well as within like the renal, GI, cardiovascular area. But we also have seen cardiovascular, each of the last 3 years have kind of gone down a little bit in Series A, which is to your point, David, that you raised earlier, not as much activity here as we've seen in the past. Although when you look at the later stage, the companies that are already out there are still raising money and going forward. But you sort of wonder about sort of the seeds that you're planting for the next generation of interesting cardiovascular companies, maybe not getting as much activity as we've seen in the past.
It's interesting, John, too, that it's not only declined, but 2 deals in all the first half. That seems to me like an extraordinarily low number. It's not like it's going from 12 to 8. It's going from 4 to 2.
Yeah, and I'm not ringing the panic bell yet, since it is only 6 months of data. Yeah, we'll see what the numbers look like at the end of the year, but it is a little bit interesting to see. But definitely non-invasive monitoring and neurology have definitely been 2 of the bigger areas. And if you look at overall, these are all the deals in the sector for the first half. Again, you see a nice up and to the right in terms of the dollars invested, which is really great to see. So again, while you say device was a little bit less than half of what the year number was, it was last year as well. And you saw actually more investment in the second half of the year than the first. So
that was M&A. That was M&A activity.
Overall, if you actually go back all the way to the invested capital side with the dollars in so far in the first half of the year, it's a little bit less than half, but I think we're feeling pretty good about that. But imaging and non-invasive monitoring really have been, if you look at total dollars, they're about 25% of the whole sector. And I think it's been interesting to see where you see some big deals like Element Science in the non-invasive monitoring area, but you also are seeing some of those areas being represented in companies that are actually developing more COVID-19 specific opportunities. And this is more related to not only the virus itself, but what happens to the lungs. And so you see respiratory imaging and non-invasive monitoring all having companies that are leveraging the situation we're having with great technologies that can help people. And so it's great to see that as a part of the device sector as well. So this gives you at least a little bit of a sense of what we're seeing out in the market. But I will say, one other thing that we've noticed on late stage financing is we continue to see the crossover investors being pretty active in this arena, but the multiple step ups that we're seeing from sort of your late venture to mezz round has really been impacted in 2020. So we sort of looked at the companies that had a $75 million post money in 2019, and we looked at those companies that had that in 2020. And in 2019, the step up from sort of the venture to the mezz round was around a 2.2x. And this year, we're seeing it down to about a 1.6x.
Your audio was cutting out there for a second.
Oh, I'm sorry. One of the reasons could be the lack of IPO market for these companies because of the revenue impact. So instead of them thinking about eyeing an IPO towards the second half of this year, they've sort of had to think about instead adding runway at maybe a valuation inflection that's not as exciting as they want to, because they have to make sure they have enough capital to get the revenue to come back to a point where they can access the public market. And maybe Marc has some perspective on that.
Yeah, I mean, I would certainly echo that. I know, just kind of chatter in the space that there are a number of companies that were, viable second half IPO candidates in the device space that have, probably put those plans on hold and raised, large rounds in the meantime, and are just kind of assessing the situation. So whether they try to go this fall or wait to the spring, it just made sense for them to, raise capital ahead of that. And there's, I think to your point earlier, there's an active crossover set of investors that are looking for those pre-IPO candidates. So.
Yeah, and I would say, joining that group are sort of the late stage VC folks too, who see this as a great opportunity to either, double down in companies that they're already in, or get into sort of a pre-IPO company at a valuation that sort of makes sense. And that.
So I want to get to the data that John has about M&A, but let me stop both of you there and ask you this question. I think there was a big contrast for me personally when I talked to folks in early April about what was going on, and then early May, where it was doom and gloom in early April, and then May, everybody was kind of shocked at how quickly things had recovered. Elective surgery coming back a lot faster. Now we're seeing a new surge in coronavirus throughout this country. And Marc, I was just picking up on something that you said about kind of delaying. How are the acquirers reading this marketplace in terms of opportunities when it's so hard to get a handle on the progress of this pandemic and any kind of light at the end of the tunnel? I wonder if either you or John have a perspective on how we're reading the longer term, not the long term, but the, late 2020 implications for all this deal activity.
Yeah, I mean, I think certainly for the commercial stage companies, whether you're an IPO candidate or for an M&A candidate, the lack of visibility right now and predictability on the revenue side, I think, is impacting things. So, again, so for some of these companies some of these later stage companies that were teed up to be going public, if you can't speak with confidence to your Q4 number or your, early 2021 number, that should probably tell you to wait. Every company is different. It depends, obviously, product wise and subsector wise, but there's an impact kind of across the board that everybody appreciates here.
So, John, you got some more interesting data for us to share with us?
I do, and apologies if my video is or my audio is not perfect, but we'll keep working through it.
Seems to be fine now. It was just
okay.
Momentarily back there.
Gotcha. Okay. Let me know when you can see that.
Oh, there we go.
Okay, cool. So let me just skip over to the DX tool side. I'm just going to spend a little bit of time on that because I know, again, DX is an interesting area, but I will say, M&A is definitely down in DX tools as well, specifically within diagnostics, but we have seen a number of DX companies that have been able to go out in the public market. So you have Burning Rock as well as Genetron, and Archer DX, which had filed to go public, got acquired right before the end of the first half. And all those companies all had pretty similar backgrounds. If you think about losses and revenues, all three companies were around $40–50 million revenue run rates, with a burn of anywhere between, I think Burning Rock was around $7 million a quarter, and Genetron was like $25 million a quarter, Archer DX around $17 million a quarter. So at least it gives you a little bit of a sense of what it takes to think about the public market for the DX test side.
And were those companies, was the response to those companies because of the opportunity for diagnostic testing in the pandemic, or were they just well positioned and doing really, really well and would have gone out robustly in a non-pandemic climate?
I think it's the latter, David, because they're both more on the oncology side, and really sort of like the liquid biopsy or oncology testing space has been a hot one. Sure. But it has been interesting because you saw Burning Rock is actually up 64% and Genetron's down 25%. So there can be a specific perspective around who your investor base is and how you IPO, but that's a whole other sort of discussion. But on overall for diagnostics and tools on the M&A side, it's pretty lethargic there. If you take away the Archer DX's $1.4 billion deal, it's a really small number, and really I think it's a little bit of the tale of device as well. Requiring these companies to get to sort of significant revenue before being acquired. Although on the device side, you do have more innovative technologies that get picked up before commercialization, which we'll talk about in a moment. But on the DX test side, it really has been a little bit of a lethargic M&A side, where it's the big players who can afford to wait for you to show that your test can get one, approval, and two, revenue ramp commercial reimbursement in order to access an end game of an M&A. But, on the device side, and maybe I'll just transition to that really quick. We do see, less M&A than we've seen overall on a half yearly basis. And as I mentioned before, it's a little bit more Q2 or second half of the year focus. So I'm not necessarily saying M&A is falling off a cliff, but I will say, when you look at the $12.8 billion in last year in terms of deals, some of that was market cap at IPO, but a lot of that was the M&A side. And obviously Norris was a big part of that last year.
Right.
We haven't seen a big M&A this year, but most of the value so far driven this year has been in the M&A side, and it's been from companies from Asia that are in commercialization with pretty significant revenues that have venture backing that are going public either in Hong Kong or Singapore markets. And those companies are doing just fantastically well. And you can see, Paija and Sanyu both up over 100%. But it's great to see a company like Inari that, I think when you think about their last private round before they went public, that I think, the story there is they talked to a lot of investors before they were finally able to find, the folks to do that round. And those folks are way, way up. And if you combine that with what we saw in like Shockwave and Silk Road, et cetera, you can see that there's a lot of opportunity for these companies to go public and then really show good aftermarket performance, which is really what will drive the returns.
Yeah, and John, where are they going public? I mean, is this a phenomenon of Asian investors pumping Asian companies, or are they going public in the U.S. and getting a ride from the U.S. from U.S. investors?
So it's really a split. And actually, when you look at over the IPOs over the last couple years, half of those deals were non-US deals, either through Shanghai or Hong Kong, so sort of China-based companies. The other half were sort of US, NASDAQ-listed companies. So it's a little bit of both. And I think what the scenario there is really, it's you got to make sure that you have a revenue run rate that feels like it's solid and that you can get to 50 to 75 million, within a year or so in terms of your run rate. It feels like that's kind of the qualifications to get out. And obviously, because of the pandemic has hit revenue so hard, at least in the near term, it's really hard to predict that. So I think you're seeing a lot of companies sort of pause right now, which is kind of leading to all this late stage financings we saw from the previous slides. So maybe
the commentary on the side, you note that M&A is on a downward trend with 46% drop in median upfront value. Is that first half of 2020 versus first half of 2019, or does that factor in, as you noted before, that a lot of deals are done in the second half of the year?
That's sort of comparing it to full year 2019 numbers.
Okay.
So again, it's hard to really look at that and say it's a terrible trend that is endemic of what's happening in device. It is just a full 6-month period, but it's a period in which we didn't see as many transactions as we would have liked, and most of those transactions were pretty small. And even the deals that were sort of PMA pathway companies, which we have seen tend to get the bigger deal sizes overall and tend to exit a little bit earlier than what we saw for the 510K deals, which typically need FDA approval, commercialization round, and ramp. Those deals tend to be a little bit on the smaller side. And frankly, on the cardiovascular side, we haven't seen as much activity as we've seen in sort of the previous 5 to 10 years, where cardiovascular has really been one of the leaders. This over the last couple of years has been more orthopedic and respiratory and some more general surgical companies that are getting picked up.
So Marc, let me bring you in here and ask you a question. So I'm a small company. I've maybe done Series C, maybe even a Series D, and it wasn't easy. And this is even pre-pandemic. It wasn't easy raising capital. And I'm going to come to you and I'm going to say, I need some more capital right now, and I need to figure out whether I'm a candidate for a public offering or whether I should go back to my private investors and try to raise money. Help me think through what what my thought process as a company should be as a CEO. What are you advising folks? And obviously, I've given you no details about the company, but tell companies across a broad range of characteristics of how they might think about whether this is a good time to go public or a better time to raise capital from private investors.
Yeah, sure. I think probably the most important thing to think of and consider is you have to raise capital regardless of where it comes from, regardless of what the source is. An IPO is just one avenue. But certainly from looking at that, again, some of the companies that have done well in the aftermarket are companies that have these unique profiles of high growth, like an RA, for instance, or visibility into a year or two out on the revenue side. So if you don't have that profile, and to John's point earlier, a good healthy set of revenue base already, you're probably not a great IPO candidate. So looking elsewhere to other sources of financing, I think, is probably the prudent thing to do there. But obviously, just to keep your eye on everything and prepare for all eventualities.
So if I'm a small company, what kind of relationship should I have with an investment bank when I'm not really in an exit, not really thinking about exit just yet, when I've still got milestones to hit before I'm ready to think about an exit? How do I think about my relationship with an investment bank like yours?
Yeah, so I think in general, it's investment bankers can be helpful to small startups. Just helping them think ahead to what does the profile need to look like at a certain inflection point. Again, obviously company specific, but helping them think out a year or two or three. What does the profile need to look like, and how do you get there? And then also how do you communicate effectively and get on the radar screen with strategics? When is the right time to do that, and how do you go about doing that? And really just frankly trying to avoid some of the unforced errors that people might do if you haven't been through this before.
And am I paying you on a retainer basis to do that, or are you providing this advice for free in anticipation that when I do finally exit, you'll get paid?
Yeah. So, in general, every bank is different, but, I think you'll find, oftentimes there is an upfront retainer or a monthly retainer, but, again, in general, investment bankers, make their money at the time of a transaction. So, there might be, kind of a nominal, cash expenditure along the way or not oftentimes, frankly. But bankers, look to make their money at the time of an exit. So, you want, both sides want that. You want your interests to be aligned.
Yeah. So one other question, because I think this is of interest to maybe a small company that hasn't gone through this process before. So where is your greatest value for me? Is it making introductions and finding a potential buyer, or is it advising me on what to do? If I'm a former Medtronic executive and I left with, good relationships with my former colleagues, and now I've got a technology that I think is perfect for Medtronic, and an exit would be great for me to Medtronic. Do I need to engage an investment bank, or are you really there? Are you really best positioned to serve the company that says there's 4 or 5 potential buyers for me, and I don't know who I should go to, who I should approach, and how I should go about doing that?
Yeah, frankly, a lot of times you just, you don't need a bank, don't need a banker. In that situation you just described, that's probably, one of them. If you as the CEO or the executive team have done it before, if you've got board members that are active and have done it before, especially if their interests are aligned with yours, or if it's a well-defined kind of narrow set of buyers and you have relationships, there are a lot of situations, frankly, you just don't need an advisor. But if you haven't been through it before, it can be helpful, not tripping over yourself, or not performing the unforced errors in terms of communicating and setting expectations with strategics. That's where an advisor, someone that does this as their day job, can be helpful. And also,
sorry, go ahead.
And also just think about the trade-offs of time too. The introductions are one thing. A lot of people can do that. That's not that big of a deal. But if you're developing these relationships and the communications with the companies, that can be a big investment in a management team's time over the years. And it might be a better ROI for that management team to be focused on a product launch or on a regulatory filing or whatnot, because every hour of the day is important. And again, that's where a banker could be of help, just to help provide leverage, especially if the team is small.
Yeah. So John, feel free to jump in here as well, and Marc as well. So one of the big changes over, say, a dozen years ago is the greater participation of the big strategics earlier in the life cycle of a company. I mean, I'm old enough to remember when, if you're a small company, you didn't talk to a strategic because you were concerned that you'd give too much away, you'd be gobbled up. Now they're coming in as early stage investors. If I am not talking to a strategic early, is that a bad sign? If they're not coming to me and saying, hey, you've got something interesting and we want to take a closer look to it, is that a bad sign for you as a company? I guess the question is, are most of the M&A in terms of acquisitions kind of baked in before you actually even get to the M&A stage, because small companies and big companies have already formed a relationship over the course of several years as the big companies have watched the progress of the small companies? Just kind of impressionistically, I was wondering whether that might be a flag for some companies.
I think it's important. It's a the business development process is a two-way street. So most big companies will have a dedicated business development person or a team of business development people within their functional units, and it's their responsibility to be monitoring and be aware of everything that's in the space. But folks are busy, and not everybody knows everything. So if people aren't calling you, it might not necessarily be a reflection on whether they think your technology is interesting or not. It might just be that they're not aware of you. And that's why, again, getting on the radar screen of these folks early on and telling them where you're going to go and then kind of doing it is helpful. But you also have to remember that, within any of these business units, there's oftentimes an ebb and a flow of a product need or not, or maybe they've got an internal project that they're working on that they think, is going to be successful. And then, that's why maybe potentially they're not, paying a lot of attention to you, and then they have a setback there, and then, you're already on the radar screen, they're aware of you, and then, they can show up and have more interest at that point. So again, to answer your question, I wouldn't, if BD folks, if you're not getting a lot of inbounds, don't take it personally. If you're reaching out to people and you're consistently hearing, hey, not a fit, that's different. But again,
that might be a reason to have a relationship with an investment banker. So John, let me ask you a question. One of the things I love about your data is how you supplement the statistics with examples from the industry. One of the things that has really plagued the medical device industry, relative particularly to biopharma, is the dearth of acquirers. And whenever people talk about potential acquirers, there's a big 5 or 6 that they always name, some of whom aren't active at any given time. But are you identifying, are you finding in your data that one of the obstacles to exit is the lack of potential strategics, or are there a host of companies that are out there that don't make the big six, but that have actually been relatively acquisitive over the last couple of years. Kind of goes back to your original who's in the acquisitive basket. I think of a company, for instance, like Edwards, which is very focused obviously on cardiovascular. 10 years ago would not have made the list of most active acquirers, but within the realm of cardiovascular has actually been a very active acquirer over the last couple of years. They just made an investment in one company. But I wonder if you or Marc can talk to how much of an impediment, how much of a limiting factor is it in this space that there aren't the dozens and dozens of pharma companies who are potential acquirers or partners in this space, that for most it's really down to one or two or three companies.
Yeah, it's a good question. And again, hopefully you can hear me. I know my speaker has been flashing at me saying it's a little bit of trouble, but yeah, I think it is an issue of there's not as many acquirers there, but it does have a lot of different types of folks that are out there. And I was going to share my screen one more time for a slide that I thought was pretty interesting. And this is just one that I did for Fogarty Innovation earlier this year, where you could sort of see a sense of who's active in this arena. And you can see that over the last couple of years, you are starting to see maybe some names that you wouldn't have thought, like a Merit Medical or a LivaNova, that aren't necessarily ones that you would say are your main acquirers. But on this list, like, you don't see a Medtronic, and you're like, well, what's going on? Or an Abbott, like, where are those guys? But as I said before, Medtronic feels like they're starting to become more active again. And then you have all these other companies that have gone public, recently, that actually have a significant amount of cash. And you just wonder, are these folks that are going to be maybe getting into the acquisition game at some point? And so far, the answer has been no, but there is an interest in adding companies to the list of products that you have out there. But I think really the biggest impediment that I've seen between biopharma and device is that biopharma feels compelled to reestablish its pipeline of assets constantly. And actually, when you think about the public market and the street, they ascribe value to those companies once they are in phase 2 clinical trials. So these companies are still 4 or 5 years away from potentially approval and or real revenue, yet the street is already giving value to this. And you see an opposite perspective on the device arena, where everything seems to be EPS focused. Nobody likes to spend a lot of money for something that is not going to almost be accretive right off the bat. Like, those feel like it's more one-off than sort of the regularity that you're seeing in biopharma. And it's a function of where we are in the market. And it's been that way for a while. But that is something that we've had to deal with. And I don't know if, Marc, if you have perspective on that too.
Yeah, I would just add to that. I mean, I certainly think that, in general, yeah, David, to your point, that, the limited number of credible large acquirers is a challenge in the medical device space. But one of the hopes, I think, is, this more recent wave of IPOs that have been successful and are growing their businesses and have developed channels, where they might have 50 or 75 salespeople and, still seeing great growth in their core product, but, they understand that layering in and leveraging that existing channel can make a lot of sense. So again, I think, some of those names that you had on your slide, John, I think are good candidates to be this kind of next wave of serial acquirers, hopefully.
So one question for me, and then I think we're right up against our half-hour break. But John, you noted before the robustness of the Asian companies on the public markets in this space. I know some folks who are counting on the next wave of M&A and devices coming from Chinese companies, but that's not a trend that seems to have materialized, at least through public pronouncements. Is there much interest on the part of Chinese companies, large Chinese companies, in acquiring Western companies, or have we not really seen that yet?
Well, I'll chat more anecdotally because it's really, there's not a lot of data to put your hands around in terms of actually completed transactions, but it feels like there is a lot of interest there. But over the last 3 to 4 plus years, there tends to be a discussion around sort of joint ventures and things of that nature, which, it just tends to, you see a lot of talk, but no action. And then I think you also, on the investment side, you've certainly seen some CFIUS sort of issues of what can they invest into and what can't they, and is that money actually coming in? But so far, my perspective is a good amount of talk, not much activity. I would say it's worth having some initial discussions, but I would just be cautious about, definitely don't put all your eggs in that basket.
Yeah, I would agree. I mean, to me, it's a lot more hope than reality, but still hope, and could be a nice avenue going forward. But we just haven't seen a lot of that activity.
So, Paul, I see us just going over by a minute. Do we want to go into the Q&A session, or how do you want to handle this?
Yeah, absolutely. So first off, let me just, so anyone who's from MedTech Innovators cohort, don't disconnect. For everybody else who's been watching on the live broadcast, really glad you joined us, or if you're watching this on a replay later, super interesting discussion, Marc, John, and great moderating, David. The data is really interesting. I have a ton of questions myself, but David is a master at asking questions, so I wasn't going to interrupt, but we can talk offline about some of those things. But really interesting to see the trends. I'm super encouraged by the amount of capital that's sitting on the sidelines at the moment, John, and really excited about what that might mean for investment. But I guess we'll have to see. So really looking forward to that. And Marc, great to have your insights, as someone who's on the ground, involved in these transactions and really being there to hear what's happening kind of on both sides of the table. So really great to hear your insights as well. So thanks for that. Next week, we're going to have another exciting webinar, same time, same place. So please come back to medtechinnovator.org/live for that. There'll also be a schedule of all the upcoming webinars now posted, so you can see what's coming up. And if you want to get the notifications when these are going live, you can register for the RSVP list on our website, and you'll get an advance email. You can also subscribe to our YouTube channel as well. So thanks everyone for tuning in. Panelists and MedTech Innovator Companies, don't go anywhere. I'm going to go ahead and stop the